I know there's been a lot of changes, and it seems to me that the conversation about Roth conversions has diminished because of some of the things that have changed. The biggest of which is the extension of the Trump tax cuts, which has led people to believe that, medium term at least, that taxes are lower, relatively lower. But, as has always been my concern and has always led my thinking, the debt of the United States is still not decreasing. And although I like the policies of the current president, and I see growth in the economy, and we have seen fairly large revenues from the tariffs, I still haven't seen a large reduction in the deficit. And until I see that, my mantra of be aggressive with Roth conversions, beating that drum probably won't stop. I think it's still a really good idea to do those conversions. We don't want to get crazy with it, but I think it really needs to be a discussion and implemented in a plan over a medium-term period. Most of the Roth conversion plans that I do are typically over a 5-year period with a bogey number. So we do a plan with a client, we come up with a goal number that we want to convert over 5 years, and then we're flexible in that 5 years depending on what increases or decreases in income might promote or detract from that number that we convert that year. 2 examples that have come up this week. I had actually a younger person, but high income. He's in the tech world and quit his tech job in Boston, moved to Texas, is looking for work but enjoying some free time, kind of has a goal to go back to work in October. So his income relative to what it is normally is going to drop. And I brought up the idea of the Roth conversion being a little bit more aggressive this year, as we had already been doing some Roth conversions with this individual. Point to note, I'm also assuming this person's income, because they are a high income earner and a big saver, probably never will go down. And I see this, I see bad information, bad advice from CPAs and other tax preparers, enrolled agents, telling people, your income will go down in retirement, but they have no idea what the savings rate of some of these young people are. I have another example of a doctor who also married a relatively high income earner. If they keep going the way they're going, they're never going to have less income, right? So you have to do a projection. And if you determine somebody is going to reach what I call critical velocity, which means they're low spenders relative to what their income is. And again, you have to be careful, because I work with some other folks that are high income earners, but they're really high spenders. So it doesn't work for them. But the ones that are high income earners and relatively low spenders, they're going to hit critical velocity earlier. And critical velocity is, that they make way more money than they spend. And so it starts adding up and adding up and adding up. And of course, you all know the magic power of compound interest, what it does to a situation like that. So, recap, that really hasn't changed, which means taxes almost clearly still have to go up. If that changes, I'll change my tune, but nothing really has changed there. Look for opportune times to take Roth. Look at your lifetime income projections, your lifetime savings projections, to make sure that, the Roth makes sense for you. And watch this market. I typically recommend doing the Roth conversions at the end of the year, but in a really growing market, the conversation has to turn to the start of the year, because with a market growing like this, you're getting it at a discount. All right, if you have any questions on your particular situation and whether a Roth conversion might make sense for you, please call my office or use one of the links below.